You can
Right.
close it.
He's like 7
It's raise it lower from behind you. Black switch. And then to turn off the display, it's just that.
It's okay.
No, I asked him this morning, it was the,
How was today? Today the 20th?
18th.
18th.
Everything good?
Well, if you write too much, he says, I didn't ask for a book. And if you write too little, he says,
You really
why didn't you write a book?
In front of me since I don't know anybody's name. Because I just hate saying like that.
not one sentence
Put it on top of your monitor. Just so I can see. I hate like yelling out. Yes, you maybe just can you just put your name like put it on the 10 card like on top of the monitor. That can be whatever. You know what I'm saying?
Oh, just so that we don't look at it.
No. Just so I can know what your name is instead of just hey you.
I thought you wanted them like to hang right
No,
there. Make it pretty, guys. Make it pretty.
It's on the board right there. It's RN. Yeah.
Yeah, I was only
Oh my God,
with sparklies and stars.
At work, nobody still knows my name.
Do you have any traffic advertising majors? Somebody make my name tag pretty. Anybody?
Just put the billing in there.
Yeah, you know. Can we put our tag names on there?
Highly encouraged, yeah.
Highly encouraged.
Do you want me to put it on this computer?
Yeah, actually, yeah.
No, put on this one so you can't see it. Totally defeat the purpose.
Tyler,
Wait, what's your name?
Oh, I see.
I listens.
Well, if I'm trying
listens
to
to
never
us,
go
right?
read it.
That's like extra bold too, isn't it?
Yeah.
I didn't think you'd be able to see all these little names.
I'll try to.
I was trying to help.
Just at least for today.
I was trying to be helpful, Tyler.
Good job.
Thank you.
Yeah. Bam.
Oh my God, I know, I'll never forget that.
There you go.
I was, sometimes I'm like, really not, it's so hard. I don't think about it right now.
I remember actually the first time you hit me up on like LinkedIn. I was like, who's I listen? Oh, listen, I get it. I know her. Good night. I accepted it.
Let's do it.
Hey, look me up on LinkedIn.
I was on the last.
Really?
No, I was on when I got to that.
Listen, you gotta get on it.
I
I mean, I did it, and
But that doesn't, you don't realize that you get ripped by the sun. Yeah, you got to breathe. I know why. No clue. I was ripping those schnapps by the end of it.
okay, well,
That was
That last year, I was like, oh.
yeah, I went through that last night.
I think we're waiting for a couple of stragglers, yeah?
You saw me the first one. I was looking for it.
I know.
I thought it was a disaster at that first one. I went pull, and then I chunked it away. This is going to be bad.
It's worse out there.
Yeah, my first one was like really bad.
Oh, actually, I didn't even know that. Because I knew it all thing.
Did you guys play Jack Ronda yesterday?
Oh, no, Jack Ronda, yeah, I played, I used to go
Downstairs to
down.
the.
Oh, okay.
Probably the people.
We played out in
No race and international leagues.
right next to the airport.
It didn't happen last week, last Saturday, I don't know if you remember.
We played in the.
You worked there when you were a kid. With the,
There was a real estate related tournament at Jack Ronda yesterday.
I heard about that one.
Yeah.
Yeah. Ours was for insurance, some insurance.
Yeah, insurance association.
There was something.
We should have won too.
We did.
They matched cards and we lost, yeah.
Those two first places.
Those two first places.
They didn't have a.
What did you guys shoot?
61? Like 10 under.
I think they used one of my balls. They used my ball one
Yeah,
time.
you swing
Oh,
hard.
it is awesome. This guy scramble on that course gets me
Oh,
dangerous.
we had a good time.
Yeah,
It was.
we missed like 9 people.
I carefully
Yeah, you are.
use
Yeah.
them.
It's normal.
Normal?
Yeah.
Okay.
Well,
Well, we'll just start them. We've got some stragglers.
Okay.
We're gonna just have a little recap quiz, but I'll formally introduce myself again. Most of you probably had a quick lecture from when I participated, like a month ago or so, and have since been asked to join as an adjunct professor here at Nova, and so I'll be kind of leading this course for the whole quarter. And Fred's gonna jump in here and there. But again, my name is Matt Fuller. My email, I have a new Nova email, so I feel really special.
Fancy.
It's official. And but again, yeah, my background again is just more on the application of the real estate finance investment side of it. Just kind of a quick rehash. I do not have a graduate degree, or in terms of an advanced degree, MBA or whatnot, but pretty heavy in the real estate finance side of it for the last 14 years, and the investment side specifically since 2008, when there was really great opportunities, when the market kind of presented itself when it blew up. So that's what I want to kind of bring in is a completely different angle to the book.
Okay.
So
Okay.
that's good. I like that. A little extra caffeine. But yeah, I mean, taking away just kind of from the strict academic approach and really being able to kind of tie it to more case studies of local projects, of deals I've invested in, deals I've financed, equity, debt, mezzanine, preferred equity, with kind of just trying to bring some local flavor to it. I mean, I think just to be able to apply it differently and kind of maybe see some real life examples versus hypothetical Argus runs, which are can be numbing in this book. But I'm gonna quick quiz, basically based on the reading, chapter 11. We're gonna kind of knock out, and I'll update the syllabus, but that's chapter. Bless you.
Thank you.
Every class. So chapter 11 is today, obviously, which is very, very broad. And then 12, 13, and corresponding future classes. So this is just kind of a quick recap. If you can just throw everything away. Basically, we're going to do this at the beginning of every class, and these are happen to be 5% of your grade. So
Yay.
each one. How much? 5%? Yep.
You said everyone? Like 5 total points. Like 5 out of 100.
5 out of 100. Think about sure. Pretty straightforward stuff. I hope.
Thank you.
It's relatively straightforward, looking for good, thorough answers that we can chat about with a lot of follow-up here. And take your time. I'm not going to do this within 10 minutes. I just really want to have thorough answers. it's going to, well, he was just emails that it's gonna evolve too. So, this was fun.
Yeah, it was. So I'm not aware, like you said, there's more. Should I purchase it versus rent it? I mean, you say you're gonna have a different spend.
I'll get into that.
Yeah.
You definitely need to get it for just
Just to have.
yeah, I mean, you know, I've owned, this is the third edition of the same book that I've owned. Actually, one of these guys was my professor.
Oh, really?
So, you know, I own it just for reference purposes.
Yeah.
It's pretty valuable.
Okay.
So you know, it's not cheap, but it's, you know, if this is gonna be a serious track for you,
Yeah.
it's a great reference. We can try to wrap up maybe in like 5 or so. Can some of you just hold down on the chatter just so people can finish up around here real fast? All right. for wealth creation. And I was yes.
So I don't know whether Matthew or Mrs. Board told you I was from the city in your class.
Welcome.
At least 12 months.
All right.
How are you?
Yeah. It's going to be pretty interactive. Huh? You don't have to know anything. Just listen. Okay.
What?
Okay.
Working out.
Yeah. Wherever you going. Is that everybody? Everyone's in? You one more? Okay. I've taken myself out of the market for 8 years. Something it's not my personality.
Yeah, it's got to be something that you want to do. They don't necessarily for your impact.
And then you do it very high profile. Consulting with a for-profit group, and that's what the guys, they're serious. I think it's about the money. This is fun. I mean, I teach this at MIT about we'll talk about undergraduate lecturing and stuff like that outside.
The concept of teaching is very interesting. You can show people what you've learned and help people make certain type of decisions. It's never really seemed like a thing to do if you're trying to make good money out of it.
You guys
Whether
don't
it's
care. That kind of that local sector knowledge, understanding
and that's what it's about. Finding that with the single wave stuff. She's fancy.
I know, I had an event last night.
She took it back. It's that TLC, it's a little, some you seen on, what's the name?
I know, right? For real.
Buying really hard.
We'll take a couple steps back. As one case, what kind of tags you guys are for?
I don't know, man. Yeah, the last night. Yeah. Don't drink sugar.
I think there's some that are, May 23rd, I think so far. That's even better. And I'm here, I think there's only 3 that I'm not attending.
This is the class that's every year.
Yeah, except for I think one Saturday.
Are you punked out too?
Hey!
Punked out.
Remember I told you? And
and they still haven't added my class. So what he's been doing is sending me stuff to my personal email, and it doesn't.
All right, we'll get started and jump right into it. Just from a style, perspective, like I said, I'm going to kind of bring in a different angle. I don't want to just kind of regurgitate everything coming out of the book. In the industry, everybody. I know you were with Terry Stiles, I think, last Saturday, touring around. Incredible knowledge base, and the guy just dominates South Florida. I mean, Stiles is just a fantastic name in the industry, from an equity perspective, from a debt perspective. He's a great, fair partner, and he has a pretty good design wit to him as well. I will say that. I've worked in buildings he's built for 11 years between Miami and here, so for some reason it's been a good match. And he's a great guy, and I've been a client of mine too. So I think 75% of you maybe already took the finance class, maybe. So a lot of the NOI numbers, maybe not quite taxable income, but a lot of and correct me, because I want everyone to kind of be on the same page as we kind of dive into it, but I think mostly all of you pretty much have a pretty good gauge as to the basics of, because chapter 10 previous to this, which I think you would have covered in the finance class, was ending up with value. Can't listen to me? All right. I'll speak up louder then. Is that better? You want me to be closer? But then I can't see this man. All right.
The HVAC system.
Just gets loud better.
We got some seats up here, guys.
Is the AC actually on?
Not really.
But
It just makes noise.
Just makes a lot of forced noise. Yeah. So at this point, what we want to be able to is understand. So now you understand value, and really understand kind of now it's the investment opportunity. And kind of going forward, it's all going to be okay. An opportunity's presented itself, and how you're really going to understand the rationale for purchase, hold, and do you sell? As chapter 11 kind of went through pretty explicitly, commercial income producing real estate is an incredible wealth creator. I mean, there are some people who have made an incredible amount of money, also lost an incredible amount of money due to a lot of indications in the market that maybe a lot of people couldn't control, or they just probably just didn't have their eye on the ball, And when I say that is that the industry in terms of ownership is just really, really hands-on. The leasing, the management, the debt side of it, managing your equity, managing your hold period. I mean, it's pretty dynamic, but incredibly stable, as I'm sure a lot of you had kind of hinted at in the benefits of ownership of real estate. The tax advantages are incredible. I mean, to depreciate something for 39 years is unprecedented. To be able to write off mortgage interest, to be able to have access to the level of leverage in something, speaks to the stability, the benefits of ownership. And look at the players who are involved in it. Pension funds, the REE liquidity today is astounding. It's staggering how much money's been raised in the bond market, in the equity market, how leverage has declined. One of the biggest interests in me wanting to just participate more full time in that this book is actually pretty dated. It's 2011, but previous to the recession, I would say that the book was probably rather current. It gives you a lot of good snapshots of how things are operating, but it's really dynamic now more than ever. Kind of post, we'll call it just post major recession, and the banks are your equity partners are asking for things that have never been asked for before. Banks are asking for items and underwriting differently than they had previous to the recession. And so I think I wanted to then, like I said, kind of bring a different angle to an industry that's changed radically in just 5 years, just when this book was published. So, you know, does anybody, first off, have any questions kind of from the quiz, from what they've already, you know, what you guys want out of kind of this class, or any questions that you had kind of, again, with the quiz or the chapter to specifically touch upon, because I can either jump right into it, or if there's anything that you want to explore really early on, just tell me. Okay. Okay. Cool. So, you know, obviously, we'll just kind of go into the benefits of the investment side of it before we start tackling numbers. So, you know, NOI stability is really impressive. I mean, especially especially if you're looking at an opportunity right now. You know, rents got dialed way back because everything up until 2007 was just kind of go, go, go. You know, the world's never going to end. It can only get better. The banks are giving out money. Equity partners just want to get into deals. Just show me opportunities. Find me yield. I would say almost today as we speak, we're almost back at kind of spring 2007 levels right now. I mean, in terms of things have just corrected so quickly because everything just got destroyed to the levels that you can actually kind of make money in this business again. 2004, 5, 6, and 7, very, very difficult time. I mean, it was just so competitive, and people were doing a lot of really dumb things. In terms of just over-levering, mismanaging pro formas, thinking that rent growth is going to be much more than it ever turned out to be. Appreciation, cap rates were just getting beat up, beat up, beat up. More IO debt, interest-only debt. Really, really cheap equity returns just to be able to grow a portfolio. And you'll see that a lot of those people who were just trying to grow a portfolio pretty much lost that portfolio because it wasn't even worth kind of recapturing your equity out of it. But I really want to be able to probably put into perspective from a risk return level that you're really looking at this compared to probably corporate bonds, in terms of a risk return profile. The CMBS debt's kind of in between treasuries, corporates, but that's kind of where you want to be. Yielding unlevered, probably 6 or 7%, 8, maybe 8% yields, probably 8, 9, 10 2 years ago. But 6, 7, 8 feels pretty good right now. I mean, that's kind of your benchmark, I would say, to make an investment kind of worthwhile. And the book will kind of tell you, well, you're going to be looking at where rent, occupancy absorption is going to be, where the construction supply is. Well, other than Terry, there's not a lot of people that are building things down here. Yeah.
That's 6 to 7%. That's like an institutional unlevered return.
Yeah.
But Terry Styles is not going to get into a project unlevered 6, 7%.
Probably not, unless it was a really infill location. Kind of talk about the core, the value, core plus locations. I will say that he's probably going to build to not much more than that because a lot of his equity is institutional equity. So he does a lot of business with Guggenheim, AIG. All those guys just really want good, solid, large assets and in stability. Most of the life insurance companies need 6.5% typically to cover their life policy gaps every year. So if you can be just right there or slightly better is really your comfort point. So pension funds are about the same. Pension funds now are even getting into institutional quality, large multifamily deals at like 5 caps, just because you can't replace that. So if you can lever it slightly, you're feeling pretty good in the mid 5, 6 for 10 plus years of ownership. Yes?
Yes. I think that there are another factors like in the cap rate, like the property tax and other things, that the value of the property 2 years ago, for example, was less like now. And the government adjusted value. And the cap rate for the investor changed a lot, because right now, for the next year, and the past law, the property tax go up a lot and the cap rate go down. They are external situations that interfere in the return of investment as well.
Yeah, and real estate taxes are just one
Yeah,
component
because
to
it's
it.
like, well, during the crisis,
Yeah.
if you bought a property in a low price, the property tax was low. And maybe the business was better inside the prices, like right now there are more stability. There are different factors, I think so.
I 100% agree with you. But the real estate taxes is probably just one component to that value and that realizing that opportunity 2 years ago to today. I mean, if you're looking at most of the Publix anchored shopping centers or the high profile office buildings, you know, the AutoNation building, I know every one of the leases in that building are triple net. So real estate taxes, insurance, all that CAM is getting passed through to the tenant. So any increase is going to be absorbed by your tenancy and shouldn't really materially affect your value as much, unless a tenant, you know, those CAM reconciliation, you know, the CAM reconciliation at the end of the year is just much higher than a tenant's expectation. You know, some tenants say, "Oh, I'll just move out of that building and go into a cheaper one." But from a value perspective, most of that's going to be absorbed by your tenants. So yeah, insurance has come back.
Yeah.
You know, to be quite expensive, just because we haven't had any storms. But you know, real estate taxes, yes. I mean, most of those values, when you vacancies or foreclosures of some assets, I mean, everything was reset completely different. But yeah, as it's now been closer, fully occupied.
Yeah, I don't know in another state, but in Florida there are a lot of investors from another countries, and there are a lot of availability to rent, and you cannot transfer all the costs to the tenant because the competition is very high. Because I don't know exactly what is the percentage of investors here that put the money in this industry right now, and the people who want to buy the house to live. I don't know. I have not the percentage. But I know that the people from South America or some countries from Europe invest a lot here in Florida. And there are a lot of apartments in residential. I don't know in commercial. Commercial, I don't know this field. And if you want to increase the value of the rent, the tenant go to the other apartment.
Correct.
Because they are offered.
Yeah. And the residential side, we won't probably get into that as much in this class.
Yeah.
I mean, let's just kind of focus more on
Yeah.
the income producing side of it, on the commercial side. You know, third party tenants, those are levels that you can control a little bit more. I mean, that is one of the biggest risks to a residential rental is you can't control what your insurance is going to be. You have no economies in that unless you're one of these resi REITs that are focusing on for rent single family homes. But yeah, I mean, it's really hard to scale. It's really hard to control costs, and there's just so much available, you know, properties. So you're right. I mean, your rent increases. You know, unfortunately, you can't really control. You almost have to do it in some cases. Yeah.
The book, it mentioned that typically landlords would put expense stops into the contract. Can a tenant negotiate that if
Always.
it's like a triple net? I
Always.
mean, like literally, they have expense stops, regardless, as opposed to the.
Well, the triple net is going to be the competing lease style
Yeah.
to an expense stop or a gross lease or a gross modified lease, where some are going to be capped and others are going to be absorbed. So you'll see that the gross lease usually was a lot more popular, you know, before, because tenants just obviously they just want to run their businesses and pay their rent. And now, as more of the expenses became more variable, you know, in some cases, especially down here, with hurricane insurance, post 9/11, terrorism insurance. Some of these landlords just got blindsided by, why in the world does Terry Styles have to have, terrorism insurance for one of his buildings downtown Fort Lauderdale? Is it a target? Everything was a target at that point. I mean, I would say I was shut down lending-wise for about 6 months in the capital markets post 9/11, just because you didn't know, what the impact was going to be. It was a pretty wild time, and it showed that high-profile real estate was actually a target. You didn't ever think. And what's interesting, and I heard, maybe it was almost a couple weeks ago, that next door to actually the Twin Towers is one of the biggest data centers in New York City, right? Did anybody else, kind of expand on this? But that's, you can't really value the difference, but my gosh, the difference between hitting the Twin Towers and hitting that data center next door, like some people are saying the data center could have been more catastrophic than the Twin Tower destruction, outside of just the physical, because that just wipes out most of the 5 boroughs, so it was wild. It was right there, and it was just, those things are just totally bulletproof, overbuilt, cost $800 a foot to build something like that, because it's basically a fortress. And I financed a couple of them in the last couple of years, not that one, but in Atlanta and some other hubs. But yeah, so it's hard to say. So going back to the leases, the expense stops help, but from a landlord's perspective, from your investment perspective, you've lost control over how much you can pass along to your tenants from a CAM perspective, over your term. So if you're really kind of short-term minded, just looking at, from an ordinary, we'll go back to taxation a little bit, ordinary income type of player who's going to be, 20-25%, depending on your bracket, you could be 39% for if you own it for less than a year, versus long-term cap gains, 20%, depending on your bracket and some of the Medicare increase, which could be like 3.8%. I mean, you got to think about that long term. So I mean, the leases now. I'm not in the leasing business because it is just incredibly involved negotiation. Because the landlord, obviously, depending on their hold term, 5-7 years is probably pretty average right now with third-party equity. But yeah, you want to be able to have as much control over what your leases are going to be. And there's a lot since the downturn. Have been a lot of changes to that structure. But I'm not a big expense stop person. So, anything else? Yeah.
Are the hold periods usually, because you always hear 5, 7, 10 years, is that typically because that's a financing structure that you're going to get before it, it balloons in 7 years, or you refinances in 7 years? So that's how you kind of gauge your IRR, because that's a known fact what your net financing costs are. Is that generally why you always hear people say it's 5-7 year holding period? Typically. So I mean, it's rare. I mean, even the most liquid pension funds are still levering their portfolios at 40%. At that point, you and I would say, well, what the heck is 40%? That's nothing. Why even get debt? Well, it moves the needle a little bit. And again, you want to be able to depreciate it. You want some of that mortgage interest to deduct. You want to be able to bring your taxable income down as much as absolutely possible. So the longer you can do that, the better. And again, I think it's also depending on the real estate too. I mean, there's going to be some players that are going to go into, especially at some of the levels that some of the New York City office buildings are trading at, or malls, some of that really big institutional stuff. You can't replace that now. You can't even say I'm going to be 5 or 7 years. Some people are going to put 20-year debt on that, fixed rate non-recourse debt on that. But so 5 and 10 are probably the most common. So you can get into the cap gains. You've got some time to really kind of move rents, and maybe there could be some management efficiencies to be had. So it gives you that time to do it. So you got to be able to also be
figure out what the rental opportunities are too. And that's, you know, kind of going back to, you know, really identifying it is, you know, how local are you? Terry only does business in Florida. You know, this is his backyard. You know, and I'll just use his example because I'm sure he was pretty, he probably shared a lot of good, really good details. What's that?
I think he has something in Nashville.
He's got a team in Nashville. He does stuff in Charlotte, but it's usually with JV partners, where that local knowledge, leasing, the management, really have that rent knowledge. But at the end of the day, I mean, you're going to focus on your backyard. You're going to focus on what you know. I mean, if you're an office guy, you're going to focus on office, retail, or hire the right people that can kind of complement it. Understanding value, you know, on the surface, I think your eyes lit up when I said, you know, $800 a foot data center construction. You're like, yeah, where the hell is the value of that? Like, that's insane, you know, on the surface. You know, it looks like you could never make any money off of that, right? So understanding that value, and then the arbitrage, what else could I do with my money? You know, I think this class especially, it's, you know, why own real estate when I can just go and buy liquid REIT shares, okay? And I can be traded in and out of that. I can have dividends that are going to be taxed as an ordinary income, but it's pretty cheap, and I have no management responsibilities, I have no leasing responsibilities, and I'm investing in experts. You know, so where's the opportunity? What's your exit strategy? And so going back to the time horizon, 5 years could be fine for that. Usually here 5, 7, 10, just because most of the real estate cycles have been plus or minus 7. So if you're coming out of that cycle, or you think you're halfway through one, you know, 7 years might be pretty good, 5 years might be pretty good. 7 might carry you through the next one. And then 10 years is because typically, especially in this environment, you know, this investment environment, most people are saying, well, cap rates are really tight right now. Debt is super cheap right now. Let's just try to own this forever and put as long of debt as we possibly can put on it. On a non-recourse basis, take the interest rate risk off the table, and not even have to worry about any of the taxation involved with it. You know, we'll figure out that and just push it down the road as much as we possibly can.
Going back to the question that Dustin had a little bit, knowing that there's going to be a balloon payment in roughly about 5 to 7 years on an investment like that, how do you protect yourself, knowing that the market has its cycles? What do you do to protect yourself? What if you can't get refinancing? Mm-hmm. Like, you want to hold it for maybe 10, 20. What if it's a legacy property, whatever you call that stuff? How do you look 20 years down the line when you know you may have to refinance in 5 years? And what if you can't find refinance? How do you protect yourself against that little issue there?
Yeah, I mean, so leverage. So if there's a hiccup, your leverage is low enough where and again, the Great Recession probably throws everything what I'm about to say out the window, because everyone was preparing for long-term ownership, but didn't realize that they were going to have that 5-year call come up in 2009, and no bank shows up at the table. Mm-hmm. You know, today, all those banks are back if they haven't even been gobbled up, but everybody's lending again. I mean, it just overcorrected so much. So your leverage, you know, in considering long-term ownership, do you need to be 75%? I mean, certainly, as you'll see from a basis perspective that this chapter kind of explored, the more leverage sometimes people say the better, because you have more mortgage interest to deduct. You're creating that as high a basis as possible is only going to juice your returns on your equity as well. But yeah, if in 5 years you've only amortized down from 75 to 68, is that enough? You know, especially in 5 years, you might have 50% of the property rolling. You know, some of those, you might have a lot of rollover on the rent roll. You're toast, you know, in some cases. So you got to prepare for that. How? Well, again, leverage, amortization, and so trying to be able to drive that balloon down as much as you possibly can. Leverage and reserves. So if there are interest reserve, TILCs, tenant improvement leasing commission reserves, I mean, those are kind of all, and CapEx reserves, kind of alluded to, and being able to understand what your taxable income is, basically it's just NOI minus your interest and depreciation. So the more that you can create in a short period of time, hopefully you'll be able to prepare yourselves. But there's really, in a 5-year call to your example, how are you going to just prepare yourself for an improved refi? I mean, your existing lender is going to look at you as a sponsor of the loan, the property, the market. It's also going to look at market rents. How do you comp out? How do you compare to your peer group and your comp properties from a cap rate and also from a rental perspective? So there's no great answer to your question. All you can do is, hopefully that the mechanics of the market are going to continue improving. Rents are going to grow. You can probably maintain your expense ratio as much as you possibly can, which is going to, hopefully maintain or improve your debt service coverage ratio. Very important to be able to determine, how much of your NOI is going to be, covering your debt service payment, and those are big, talking points to evaluating an opportunity for a first mortgage. So amortization and probably going in leverage is probably the two.
So there's no true way to like eliminate the risk of refinancing.
Never. Every deal has refinance risk. Every deal has risk. I mean, you can't eliminate everything, or everybody would be in this business. But the guys who really, and gals who really do well in it, kind of have the local knowledge and they say, okay, listen, in 5 years, I know that this property compared to all of the comp set is significantly undervalued. I know that, that some apartments, we'll just use an apartment example, we know some apartment buildings are going to convert to condominiums, so supply is going to diminish. Okay, so that should be able to allow me to drive up my specialty sector and know that the rents are going to be there, my occupancy is going to be able to improve, and there's even going to be less competition from an arbitrage perspective. There's nothing else I could buy, there's nothing else that could be possibly built to compete with me for that call. So, yeah, Laura.
What's arbitrage? How would you define it?
Opportunity cost. So, being able to say, something's undervalued. We'll just look at a business plan for. We'll use this group in Orlando called Unicorp. Okay.
Oh. I'm sorry.
It's like you knew them.
Unicorp.
Unicorp Development.
Oh.
Sorry.
I'm intense, bro.
It's a lot of caffeine this morning. So they basically said they're a retail developer historically, and had all these great sites for future retail properties. The recession came in, no pre-leasing on the retail front, let's convert these and get them rezoned for apartments. They became apartment guys and said, hey, I have a better opportunity cost because I can get financing on apartments, and there's been all these foreclosures and just the opportunity to chase that sector was overwhelming for them. So they became apartment guys. And then they said, okay, well, because of our critical mass, all of a sudden really fast, the arbitrage there was, okay, I have all these great sites nobody else does, and it's very land constrained, and then they were going to take it public. And so they were going to amass all of this and said that we can do it cheaper, we have access, and our exit is in excess of what our development costs are going to be by by many multiples. And so their arbitrage was shifting sectors and being able to get to critical mass and go public. They ended up not going public. We didn't take them public, but it was very expensive, and it's a pretty intense process, and they were not probably the right management team for it either. But that's the long-winded, you know, it really kind of breaks down to, you know, to opportunity cost. What do you know or see or can foresee more so than somebody else who might be in that same sector?
So it's like just an opportunity to make a profit.
Yeah, yeah, it's outside of the value creation of it. So, you know, I would say, you know, from a specific perspective, because, you know, kind of a value add that they, you know, you throw around a property is really just more property specific or project specific, where the arbitrage could be, I think, a much bigger, bigger look at it. You know, 10,000 feet versus just kind of looking at something at 100. The value adds up. Anything else?
Doesn't that assume that there's no risk?
Well, there's always risk.
A riskless arbitrage?
No, I mean that's if you were looking for riskless arbitrage, you wouldn't be in real estate. You'd be just playing with U.S. Treasuries. So I mean that's going to be your most riskless vehicle. But yeah, that's it's a reference point though to kind of understand what your opportunity cost is. So you've got that 5 or 10 year horizon, and you've got a treasury that's 2% plus or minus today, or 190. We'll just use round numbers, 2% 10-year treasury return, and you can build to a 6 or a 7 today. Most people say, well, of course I'm going to go build something. You know, I'll have a portion of probably my portfolio in that riskless investment, but you know, 6 or 7%, where you would say Terry wouldn't do that today. Money's so cheap and treasury is so cheap, and you can get equity pretty cheap, and the access is great. Of course, you know, he's probably going to do that deal just for the sake of doing it and getting it out of the ground and then going to work on it. Yeah, but everything has quite a bit of risk in it. I mean, that you can foresee and not.
You guys were mentioning that 6 or 7% was like unlevered though, right?
Yeah.
So once you throw some leverage in there, isn't that the whole point? You throw some leverage in there, multiply it.
Of course. Some people are, I mean, a little bit of leverage in my mind is always a good thing. You know, leverage, if you have great access to it and it's cheap enough, do it.
Yeah.
Just financed a shopping center inside of Los Angeles with a life insurance company, and life insurance company was like a 3.6% fixed rate coupon for 10 years with 5 years of interest only. I mean, that's just the cheap. It's free money, exactly. It's 60% leverage. I mean, you'd be crazy not to chase that. So yeah, if it's cheap enough and the economics make sense, your leverage going in was 60% on that deal. Your interest-only payments for the first 5 years, that can, you know, that IRR just went from 14 to about 17.5 just by the debt alone. So it can be pretty.
Is that an institutional owner?
Yeah.
That mall?
Yeah. Yeah. So yeah, it's a REIT out of San Diego which is actually pretty over leveraged for a REIT. I mean, most of the institutional REITs, the Federal Realty, Simon, and they're all kind of 37 to 45% levered. I work with Guggenheim a lot. They're Guggenheim Partners out of Boston, and their multi-billion-dollar real estate portfolio that they do for that they manage for third-party clients, and they are trying to get below 40% leverage. And so yeah, it's just juicy enough to make a little bit of a pop in the return. So, yeah.
So when you say 60-40 leverage, you mean the institutional investor has 40% skin in the game?
Yes,
okay.
Typically. So yeah, so I think, I mean, equity, I think, is defined as, the book doesn't really go into it as well as they probably should. But yeah, so I think from the academic book perspective, hard equity is hard equity. That's an acquisition equity. You're writing a check at closing, 40% and 60% of debt. But I think really equity can be both hard and implied. So what you've created is that implied equity, and plays a much bigger role, I think, in the hold sell strategy side of it. If you can buy something for $100 million and have $40 million of hard equity in the deal, stroke that check at closing for it with an institutional investor, and your 5-year hold period, you've created enough value, whether it's cap rate compression or you've been able to grow the NOI, that say you're $150 million no value. Now, if you've still got room to run, and it kind of goes back to Dustin, kind of 5 or 10 years, if you still have more opportunity in there, what's keeping you from getting a new 60% loan on a $150 million value, where you're not going to have any taxation on your asset? I mean, all that refi cash out in the commercial world, as it is in the residential world, but we'll just focus on commercial, is all tax-free. So, I mean, that's incredible wealth creation right there, just by doing what the property was meant to do, is to appreciate, and you don't even have to, you can enjoy the tax benefits, the depreciation, the interest, without having to pay that gross capital gains tax, on a really high profile building. That tax is huge. That's huge. So a lot of the institutional owners, if you can own it forever, they will. The last thing they want to do is have to trade out of something unless it's run its course. So, but yeah, so the refi side of it, but then also there's no reference to it, but I think slightly on purpose, but the 1031 exchange market. So in the commercial world, you can actually delay your taxable event in a sale and roll up all that equity, whether it's the hard equity or the implied equity above and beyond what you've created, and roll it into another property. And you don't even have to pay any taxes.
There's a time limit on that, right?
Typically, yeah. So, well, after you close. It's like 6 months after you close. So
180 days.
For a 1031 versus a 1030, what's that?
180 days.
Yeah. Yeah. Am I right?
Yeah. Right? Are we right?
Yep.
Boom.
Got it. 1031 expert over there.
We're experts.
Experts.
Yeah, we got this 1031 down pat. We're gonna hit you with some 1033s.
Don't touch those
Oh.
1033s. Yes. But yeah, I mean, so you can avoid it altogether too. So and probably trade into something inferior usually that you don't really want to as much, unless you have the 1033, which is what, an extra 180 days.
Oh.
So,
2 years.
2 years.
2 years.
I thought it was 1 year.
2 years now. I told you we're experts.
2 years from closing.
2 years from closing.
2 years from closing.
How long do you have to identify?
I think it's 2 years flat. You
2
can
years.
identify.
I think you have to identify in 1, and you can close in 2.
I'm not sure, but I know it's 2 years.
I'm disappointed, Dustin.
Yeah. Well, I'll double check on that, but I'm pretty sure it's identified 1. I think that's the difference. Let's take a little break. I think it's probably cooler outside than.
Can we learn how?
We need to make a phone call.
I told them about it yesterday when I went, I told them I don't like this car.
It's usually not.
No, it's usually actually pretty cool in here.
It used to be actually.
Okay.
How do you log into this?
Right up there, RN 32-423. Ask you at the.
Sure.
So you're saying the card is like we have, and we're writing the check for $40 million. But what's a lot of these?
Implied,
Oh,
actually.
implied.
So that's probably, it's going to be whatever you can create that equity. Okay, so if you have numbers, $100 million value, and you have $50 million in debt, you create, and with that value, it's just not a great deal, and it goes from 100 to 200.
Okay, I'm worried now. I'm worried.
You've basically just created $100 million of equity. Okay, so
that's the.
So the implied, is kind of, that's not going to be as much of an academic. It's going to be, there's a big, equity itself is what contribute money, but equity is also what helps you create.
Mike never made fun of me for it.
It's a little, I mean, it's.
Yeah, I'm like trying to figure these things out when you're talking. I'm like, wait, good question.
Yeah, just ask for questions.
Okay.
Just stop making changes. There'll be a lot of references where I think the book doesn't quite get into it, and it should. Because it's sort of a you've created $100 million of equity, you're either going to sell it and pay taxes on it. What's the point if you just create, own it, enjoy it, refinance it, or do something else with it?
Okay, so because I'm and I had like the residential assets. If like if I went to this condo and it could only be like $8,000, so then it made me look at like refinancing differently. Like it's not always like this is like but then I see this one thing I'm like
Could be your worst nightmare.
yeah.
That's why I was kind of saying with property too, is yeah, that leverage that you just all of a sudden, I'm a realtor as well, but it's now worth with somebody else.
He's gonna send out like an email, but he did send out an email about like reading the marketing program.
That's where you get your most money out of. That's a fraction of what you get out of it. You can go and put a new roof on it. You're going to get tax benefits. You're going to get that. You're only going to probably investing money. So I don't know which reason you get a fraction. But yeah, leverage can be your absolute worst nightmare. And I'm going to talk about it a little bit more.
Okay, yeah, because I'm like.
Actually, I think in the next Saturday, it's kind of the day.
But when he did it, it was like a good time. Like you were saying, like the market was, so it was ideal to do it there. And do it, so it was a thought that the project maybe it was gonna benefit in the long run, but now it's just.
Well, and it's all what you do with those cash out proceeds.
Right, that's what I'm saying.
So it's like, you're underwater in your house, but you have this beautiful 911 in your garage.
Right, that's what I say. When you think about these things, I'm like, yeah, now all this money, really back into it because all the time, and now.
So, I mean, if you're going to refinance, it's typically either reduce your rate as you have those conversations in your mind. Oh, I'm just going to refinance and take some cash out, or you can't go out and buy anything else available out there that I like enough. That's the unfortunate part. You have to stuck so many people down here. That's about people globally.
Right.
But yeah, and so at the end of the day, at least when you have commercial property, it's because I'm going to go for add square footage. You don't have a lot of competing construction properties, and you can go and build 25,000 square feet. Increase your revenue stream, because you're gonna do it on a cost yield perspective, right? So, you're gonna make economic sense whenever you're going to those types of things. Some people do go and buy a new house, some people do go and buy a new car, because ultimately, you're still getting that rental stream. It's still offset. You can go get $1,000 car lease, because you know that you still have an income production that's gonna offset it. And so, that is the incredible magic of real estate. Kind of hands off. For the most part, it can be very, very hands on. Sometimes it's more up on your own. But yeah, to be able to have triple net means minimal management responsibilities and some responsibilities. It's very
You're trying to learn, I'm trying to do this, because I'm like, I like residential, it's cool, but, you know, see what else is out there.
I always tell people that I always encourage them, if they can and have the willingness to learn and put out the time, is that you're return on time, what your time is $200,000 commission, therefore, it's just going to get out. You probably the amount of things done, if not.
Yeah. Oh, that's still that. I'm like, oh my God.
What it's worth.
Yeah. Thank you so much. I just had a question about that.
Like that.
All right.
I have a friend. Sure. Okay. All right, I gotta go. Okay. Value. Sorry. Sometimes you know this isn't my first week. It is. I get it. How you doing? Well, good. So I'm trying to figure out my.
What did he say about this stuff?
You're not getting the emails, it's not registered.
I'm like,
What'd you do with that?
35 years, real estate
Oh, yeah?
This
It's gonna be there.
I'll tell you mine.
Thanks. I also have
Yeah, we had our own band last night.
how my girl look yesterday. The whole month.
Greater Boston. I know. No, yeah, no, it's a little blooper walking back. This is sports radio. I listen so much. Yeah, I mean, I think it's very, very.
What are those sneakers you want me to do?
Third-party equity, you want to make benefits.
Also, me and him were discussing whether or not I should join a big company or small one. That's all I'm first. But big companies have the capital to get a project. Saying big companies have the money to do projects, so you can be involved with it.
Yeah, but the little ones you can see, you can see like.
That was my argument too.
Good. You also put hang on side, forward, and you're doing X, Y, and then you got Z, and then
The only beef with it, like even with me, I was doing it. But I had to stop because they weren't paying me. Once. That's why I continue to build that relationship. That's what all these relationships are for. Just so in the future, we can all hopefully keep contact and probably make something that works. So that's one of the things.
I know, right? It's almost like, right.
That's exactly what I was thinking.
I joined the association all the time. Credit card companies used to have
buy it. When I hear about it, yeah, you buy a pair of boots here in this state where it's only $100 and they go sell it. Yeah. That's when I was cigarettes. Yeah, cigarettes. Get that arbitrage. It's just that spread.
Essentially, we're supposed to, obviously nothing's supposed to make the blow up.
That's my I thought these were like that's why they're called sticks.
That's somebody who's not. It doesn't still be out. Even if it's a great one, like one term from now to every time.
Is it fancy? Yeah. It's not as hell in here. How's Corgi gonna feel about you using his Legos?
Can everyone grab a seat again?
11 o'clock.
Is that?
No.
Hi.
Hello.
Yes.
My name is Brian. I'm supposed to be here to observe the real estate courses, isn't it?
It is. Welcome. Okay. For perspective? Yes. Okay.
Probably.
Headed out for the office.
Okay.
Dustin,
Chad.
you got a suit?
You want to take your seat over here? That'd be fine. So at least you want to split this. Yeah, everything that's facing the board is pretty much taken. So.
Maybe it's got both of your names. I told us to read the chapter, right? It had all that in there.
What's that? What? You can't hear in the back?
Classroom with desks like this.
Yeah. Well, the computers are.
I don't want you guys to think I'm like the,
Oh, yeah.
huh? You basically run the program.
Well, I mean, you want to, some of the group projects,
I'm the one they don't
case
invite.
studies, will definitely be
What?
presentation and.
I'm already beyond this.
I just can't, I can't.
Maybe not
I can't watch
for-
the classroom videos because it's like, you talk and it's like,
So you can't hear me in the back?
I'm trying to help you.
Okay, well, I'll just, I didn't realize that maybe it was that bad back there.
Matt, I need to give you another interview. It's pretty hot in here.
It is smoking hot in here, yeah. We should do this in the hallway. Just for my own edification, can everybody take like 2 minutes and just introduce themselves? Have you been in the industry? You know, how long? What? I think everyone has taken, or almost everyone's taken the finance class.
No, I have not.
That's okay.
That's completely new to me.
That's next, right? But I mean, I guess I want to be able to kind of gauge where everybody's at, and then, again, 2 minutes, really fast, because we want to be interactive more, and, you know, what do you want to get out of this class? You know, again, the only way to understand this business is just to ask them a million questions. You know, is this, and also, you know, if you want to know, is real estate going to be, you know, future profession, or is this just, you know, more of academic, just interested in this, in the space for investment finance purposes, you know, but maybe taking a different direction. So, you start, Robert.
All right, guys. I'm Robert. Because we
You don't have to
some
do it for everybody else, just for my own.
Because we have some military folk in here, I'll stand up this time.
It's not his class.
Yeah. We've got one. But anyway, I'm Robert. I've heard some of you guys make note of it already. I am the future billionaire of the class. I am here. This is my last semester.
How are you going to be the future?
That's very secretive information there. Through arbitrage. But anyway, I'm
What do
here.
you know that we don't in that arbitrage?
I can't tell you this stuff, guys. Come on, this is 2 minutes. I only got 2 minutes. Let me get this out. All right. So anyway, this is my last course in this particular class. I am here for the educational purposes of creating a career. So that's really all I'll say. But hi, Robert again. Robert.
That was dramatic.
Thanks, guys.
Faster with less drama.
Hi, my name is Antoine. I'm here to learn about mostly commercial real estate. I would like to focus on the investments on shopping centers and office buildings. And it's my first time here in the program and first semester in the first class here.
Welcome. Any history in the industry?
Yes, I have taken 3 courses in this class.
But no professional.
I do an internship with a small developer, but that's kind of weird. Milton Jones Development, which is in Fort Lauderdale.
Okay. Any industry?
I do property management a little bit in commercial.
Second semester, I developed utility scale wind farms for NextEra Energy Resources, which is Florida Power and Light sister company. So that's my industry experience, and I don't know, educational, and then maybe future opportunities.
Gotcha.
Maricela Pimenta. I'm an engineer, and I've worked mainly with building water plant treatments and more focused on the environmental side of construction. And
You need to bring your desalinization skills to Southern California.
Yeah. And what I want to get out of this is just do something sustainable on a small scale for its residential.
Great insight.
Hello everyone, I'm Olivia Roberts. This is my first semester. What I hope to get out of the course is learning more of the, marketing side of real estate in terms of networking with the developers and whatnot. I currently work as a finance manager for a real estate development trade show.
Which
one?
one?
Pardon?
Which one?
Miami New Construction Show.
Okay.
And at the end of it, I would hope to be able to construct and formulate some new condos in the Bahamas. Yes.
Where?
Thank you. More like Coral Harbor area. You know about the Bahamas? Nassau?
I know about them, yes.
Okay, Nassau. Nassau, Bahamas, more in the sector of, you know you have a lot of hotels building there.
Yeah.
More in the sector of like Coral Harbor, Cable Beach area.
Okay. That I don't know.
I think you should go towards the Saunders Estates.
Saunders.
Can I go? I want to go downstairs and check with the guys about the AC. See
Yeah,
if I can
it's
get
getting
them.
worse.
Yeah.
Yes, thank you. There's nobody there.